I want to talk about my first big sale in the industry. And this video will help you if you are in the business. Maybe you're really struggling to get things going, or you're just trying to get to that next level. And if you are a policyholder or considering a policy, this video will also provide some value as we're going to look at an actual policy. It's an in-force illustration. It's a policy that is going into its 8th policy year, and the person is done paying into it. And you're going to see how we made some adjustments with no more payments going in, how to improve the long-term, or I should say short-term and long-term cash value and death benefit. It's really interesting. So it'll be good knowledge for you to have if you're looking to get a policy in order to how to make sure you get it right. So to begin, I am 26 years old at the time. I'm struggling. My first year in the business, I earned a total of $5,500. Year 2, $8,000. Year 3 wasn't that much better, $8,500. So I'm struggling to get by, and I lived at home. Like that's how I made it, to be honest. It was nothing special, but my parents were very loving and very supportive. So year 4 comes along. I am starting to build up confidence, get a little bit better. First big potential sale comes across. I get in contact with her. I'm going to refer to her as JJ for this video, for confidentiality purposes. She is 67 years old when I meet her. I'm 26. She's interested in high cash value life insurance. I'm up against competition. She's meeting with agents and advisors who are much more experienced than me, selling the same company products for high cash value life insurance. And to provide some perspective here, and if you're in the business, this may speak directly to you. I'm 26 at the time. I was not confident. When I had to make a phone call, my palms would sweat. I would hesitate before I made that call and think about what I was going to say. I could feel my chest beating. My voice would kind of shudder. You could hear it because I wasn't confident getting things out. Like, it was difficult for me. Now, I knew the product in and out because my background, again, was in designing policies for corporations for high cash value life insurance. I was a back office guy, playing around with numbers. I was a nerd. But I had the knowledge, I just couldn't communicate it effectively. That was my struggle. So I am working with JJ, and we mainly communicated through GoToMeeting, phone calls, and a lot of email back and forth, which at the time I was comfortable with. Email, I could take my time, draft a response, proofread it 18 times back then, and then finally hit send. But in that conversation, or those conversations with JJ, she has an adopted daughter. At the time when I met her, JJ is 67 and her daughter's 8 or 9 years old. I can't recall the exact age. That is a huge responsibility to take on later in life, but she did it. And her daughter means everything to her. Everything is going to go to her daughter. She has a trust set up. The life insurance policy, she wants that set up where it's in the trust, the beneficiary is the trust. She wants everything to go to her daughter properly. And it's very important to her that no one else gets involved and gets their hands on that money if anything were to happen to JJ. Critical. She expressed that on more than one occasion. So in talking to her, when she had come across our website, when she was interested in high cash value life insurance, what was she interested in? I just said it, high cash value life insurance. However, in those calls, her daughter is much more important than the high cash value product that she can access to, borrow and repay. She didn't want to see all those details, how to maximize the internal rate of return. No. So my nerdy personality would not click with her style. The death benefit was number 1. How I figured that out was really I just listened. So if you're in the business, the most important thing you can do with your prospects and clients is listen to them. Don't just be quick to show your product, your solutions, your strategies. Listen. The cash value was important. She stated that several times. She knew what to look for. She'd seen examples of high cash value policies. She knew that she should have between 85 and 90% of her payment in cash value right off the bat and working with other people first, and she wanted access to it. But the death benefit is important for her daughter. So before we get into the funding, I'll let you know that she did decide to work with me. I remember getting that email. It was an evening. I pulled up for my congregation meeting. It was a Tuesday evening, and I see the email on my phone, and it reads, "Steve, I'm taking a deep breath right now. Let's move forward. Here's the funding I'm going to go with." I'm like, woohoo! Now, since opening that policy or since starting that policy, I've actually had the privilege to meet with her a couple times, twice. She lives out in the Midwest. I've been out there twice, once to meet her. My wife and I were out further west on our way back. We stopped where she lives for a day just to visit her, had dinner with her. It was really nice. And then I had a business meeting in her area with another company several years back and took the opportunity to meet with her, see how things are going. And during one of those meetings, those dinners, I should say, at a very nice restaurant. I say a nice restaurant because it's about a professional football player. He opened it, and I like steak. That's all I'll say. But I remember this distinctly. She hands me a picture of her daughter and says, "Steve, like, this is what I want you to do. Make sure if and when anything happens to me, she's taken care of." And since then, she's emailed me several times saying, "Hey, don't let anyone else get to this money if anything happened to me." She's got it all spelled out in the trust. But what's her most important objective here? Making sure her daughter is taken care of. And I still have that picture. We want to listen to those we work with and help them out. So what she did, the planned funding, what she planned for when she started the policy was at what we see up here. $57,000 per year, years 1 through 7. Years 1 through 5. Then years 6 and 7, $100,000 per year. She was expecting to receive money from a life insurance policy from her family. So it was a smaller policy, but she was going to take that death benefit, move it into her policy, create generational wealth, continue that same pattern. It's interesting how that works. You don't need to have a ton of money to do that, but she was going to take that, move it into a policy, and then maybe, Steve, I'll pay $30,000 per year, years 8 through 10. And I asked, is there any chance you want to pay into the policy longer than 10 years? No. Started at 67, that would take her up to 77. She didn't go 10 years. You're going to see the example. She's actually about to stop payments altogether right now, 7 years into it. Now, I mentioned this was my first big sale, so I've got to let you know the amount. Otherwise, I'll be one of those guys that just talks and doesn't provide information. I hate that so much. So at the time, this was a policy designed as we always design policies. Minimum premium, maximum cash value, so minimum compensation. I earned a net compensation of about $7,000. It was a little bit less. Now, to put that in perspective for you, what I make the first 3 years in business, $5,500, $8,000, and $8,500. So one sale almost makes what I made the entire past year. And I was getting other clients, working with people. It was finally starting to pick up. I was getting comfortable. It was big at that time, and that is still a big one. I mean, in any cases, if somebody buys a policy and you make a couple $100, it's their money going into the policy. Treat it like it was your own. Help them out. Listen. So that was her plan funding. Here's what she ended up actually doing. Years 1 through 5, according to plan, $57,000 per year. Year 6, $200,000. She said, "Steve, I've got the lump sum of money. Can I just pay it all in one shot? Like, I don't want to spread it out over 2 years." And the answer was yes. And she did that without underwriting. When she started this policy, she received a standard non-smoker rating. So JJ, she wasn't unhealthy, but she did not get a preferred rating or anything like that. To make a big payment jump like that, you must set the policy up properly from the get-go. If it's not set up and you want to increase a payment like that, typically the company is going to want to do some type of medical underwriting. And then year 7, she said, "Hey, I've got another $100,000. Can I pay that in now? But here's the thing, after that I'm done." Whereas originally, she may have wanted to pay in $30,000 years 8 through 10. So after this, nothing else. Okay, no problem. We're going to show you exactly what the policy looks like. Here's the last thing I want to touch on. Have you ever planned for something 5 or 10 years ago and things changed? The plan is different now than what it was back then? That happens all the time, doesn't it? So when she started the policy, the death benefit, the actual amount of life insurance, was $1.2 million. It was a high cash value life insurance policy as well, whole life with one of the 4 major mutual carriers. So $1.2 million, and she wanted it, when we first planned, she wanted that 1.2 to remain intact forever and then eventually increase. Now, as time has passed, she's adjusted her funding period. She can stop paying anything in and still have the same $1.2 million. But I look at the plan when she says, hey, I'm done funding. Her anniversary date's coming up. I look at it and say, okay, I can give her exactly that, show her what it looks like, no payments going in, $1.2 million, cash value keeps going up. We're going to pull it up in a second. But just looking at the situation, I look at it and say, you know, if we take that death benefit and temporarily reduce it, what that will do is A, give her a lot more cash value, short-term and long-term, but long-term, it'll give her a greater death benefit as well, compared to just keeping it at 1.2. Now, before I just go in and say, hey, I've got this great idea, let me show it to you. How we communicate to people is very important here. What was her original goal? Everything to her daughter, the 1.2 when we first met, very important. I see something that if I'm her, I would definitely consider and I would probably do it. But I've got to communicate this properly. And I have zero financial incentive when I show these different options. This is just showing her options so she sees what is in her best interest and she can pick the one that will benefit her and her daughter to the absolute greatest degree. So let's take a look here. What we're going to look at first is the original plan with the actual funding. Here we go. So she's in policy year 7. Policy year 8 is coming up in about 2 months, a little bit less actually, just about 2 months. So at the end of policy year 7, she'll have $575 in cash value. What this option represents is her making no payments forever, cash value continuing to grow, and maintaining that $1.2 million death benefit. So if she dies, that goes income tax free. This is a 1-year term rider attached to it. As the whole life death benefit comes up, the term comes down, keeping her level at the 1.2 until it becomes all whole life. The annual IRR, this is the internal rate of return, what her money is growing by each year. What are the core benefits to a cash value life insurance policy? Safe, liquid, tax-free. This is one of the major mutual companies, a little bit older individual when she started, non-smoker rating, not bad. Tops out around that 3.9%. Now eventually, at 95, based on the present dividend assumption, that death benefit goes up. So if she dies between 85 and 90, maybe a little bit after that, it's probably going to be 1.2. She does think that she's going to live for a long time. She probably will. Her father lived until his mid to late 90s. And statistically, females live longer than males. So there's a good chance she has a lot of longevity in her family. So this is the option that she originally wanted and what it looks like. So I look at it and say, okay, this works, but we could also do this. So here is the exact same policy, and this is not a change we make or something we schedule when we first start a policy. This is an after-the-fact change. So we've got to know how to do this. But what we did here, let's put this in red, minimize the death benefit and maximize the cash value. So what do we see? Year 7, since we don't make the change this year, it'd be in about 2 months at the beginning of year 8, year 7, everything's exactly the same. $575 cash value, $1.2 million death benefit. Year 8, what do you notice here? The example where we keep the 1.2 million, you're at 596. The example where we minimized the death benefit, what happened? Cash value It's about $9,000 greater, 605. Big impact immediately. Death benefit, however, dropped by about $230,000, a little bit more. 966 and change compared to the 1.2. So as I look at this option, before I present it to JJ, I know that's going to be the pain point there. If she doesn't do it, this is going to be why. Next year, what happens? Well, first, let me look at the annual IRR. That's a nice advantage there. You get that bump. Same dividend application. This is just a dividend paying whole life product. It's a limited pay product. When you exercise a reduced paid up option on these, a lot of times you will see a bump in the IRR, which is sweet if you're laser focused on the cash value. What happens the next year? Grows from 605 to 636 compared to this 618. You see the cash value is pulling ahead and your earning rate is stronger because we minimized the insurance expenses. I don't want to say eliminated. We pushed them as low as we could. But what's happening to the death benefit here? At what age do you finally have more with option B compared to option A? 84 based on the present dividend. If dividends come down for a bit, it might be between 85 to 88, maybe 90. The thing is, here's exactly how we presented it, as an option. Because again, we've got zero financial incentive. It's based on what is the client's objective here. It gives them significantly more cash value. So let's take a look at age 90 here, or let's go to 85 to 90. We'll go 80 as well. 80's up top. What are the differences here? Cash value at 80, 716 compared to 772. That's a gap in cash value. Death benefit though, option A, you've got almost 100 grand more that will go to her daughter. 85, circle this in green, cash value, 843 in option A, 964 in option B. More cash value. Death benefit, 1.256. Now we've got a win-win there. And then if we finally look at 90, and we can go further than this as well, 960 in option A, 1.2 in the death benefit, and over here, 1.165 and 1.4 million in life insurance. Big difference here. Same policy. All we did was keep the insurance expenses on one to maintain the 1.2 million. The other one, we dropped the expenses as much as we can in order to beef up the cash value performance and the long-term death benefit. So, showing the different options, and really the question to ask yourself if you're JJ in this situation is, here's the advantage: more cash value immediately and long-term. Here's the disadvantage: less death benefit and the 1.2 million. I know that was extremely important to you. So if you think or are concerned, if anything happens to you in this period of time, about 10 years here, a little bit less, this is not the option to go with. If you look at those figures and you say, you know what, if I die at 80, 1.1 is left, so it's $100,000 less, but I'm banking that I'm going to live longer, there's a good chance for that, then that's where option B can work, because I've got greater long-term value. It's a decision really for the consumer, the policyholder. As an agent or an advisor, we can provide tips, recommendations, but we've got to be transparent with everything. So JJ did select the second option, option B, because she looked at it and said, hey, I will take that. I mean, if anything happens to me early on, there's a substantial death benefit here, but at the same time, I'm expecting to go for a while, has been keeping herself healthy, has been doing everything properly. So that was my first big sale in the industry, and then we get to see what it looks like today, 7, almost 8 years later, just as time has zoomed by. But I do hope that you found some value in this. Reach out if you have any questions. If you like this video, please hit the like button, subscribe for more, and we'll talk to you soon. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.